So we're getting ready to talk about some exciting material today. It's the beginning of the new year. Lots of exciting things are expected to happen in 2019. And so we just want to start the year off giving you a lot of good information as it pertains to what's changed for you as a federal employee. So today we're going to be talking about the TSP and tax updates. So without further ado, let's go ahead and look at our agenda. Today's agenda, first we're going to learn the new TSP contribution limits. They may or may not have changed. I'm not going to let the cat out of the bag just yet, but we'll be talking about the new contribution limits. We're going to talk about tax code changes and how they apply to you. We're also going to unpack the TSP Modernization Act. This was passed a few years ago, but they took the time, to thoroughly think this thing out and develop new processes for the TSP Modernization Act. So now that we know more, we are excited to share with you about the opportunities that are coming your way because of this law change. Then last but not least, we're going to talk about using these updates in your retirement planning. This is all good information, but it's really a home run whenever you can apply it to your current situation and to where you sit currently. So that's our agenda for the day. Without further ado, I would like to introduce our president, Mr. Brandon Christy, to come talk to us about the new TSP contribution limits.
Great. Thank you, Abby. Thank you. Good morning, everyone. A little background. I own two companies. This is the 10th year of Retirement Benefits Institute, so we're excited to have 10 years now been diligently working one-on-one and in group settings with federal employees, helping them build a successful retirement understanding so they can understand their benefits, begin to plan, and actually effectively retire. I also own Christy Capital Management, a financial planning firm that mainly works with federal employees to help them retire, manage their assets, things of that nature. So let's jump right into the contribution limits, and let us learn the new TSP contribution limits in their completeness. First, the Roth IRA contribution limits are now $6,000 and $7,000 if you're 50 or older. The Roth TSP is now $19,000 or $25,000 if you're 50 or older. So that's a $500 a year increase from 2018. Pretty large percentage increase on the Roth IRA or traditional IRA. Obviously not a big percentage increase on the Roth TSP. But those are now the new limits, and that applies for Roth or traditional TSP. And yes, you can do both as long as your income is not above the limits for the Roth IRA. Note here on the screen, married filing joint. If your modified adjusted gross income crosses that $203,000, then you can't do the $6,000 or $7,000 direct contribution to a Roth IRA. But the limits are up, so if you need to adjust. If you're trying to max it out, then you can adjust upward your biweekly contribution to the TSP as you see fit. Remember, FERS employees, you need to make sure you're contributing at least 5% of your pay every pay period, all the way through the end of the year, to make sure you're getting your match. Your match in your TSP happens paycheck by paycheck, 5%. And last thing on this, because I've got Roth TSP on the screen, if you decide to contribute all of your money to the Roth TSP because you want to pay tax now, but you don't want to pay tax later, and I'll get into why that would be very critical for some of you. Stay with me. If you want to contribute all of your money to the Roth TSP, you can, and you FERS employees will still get your 5% match put into the traditional bucket. So that Roth TSP is very open for you. So let's understand these tax code changes, and I'm going to talk for just a minute about the biggest change that happened actually for the first time in 2018. We saw the removal, the removal is a good word, of exemptions for us in exchange for a much larger standard deduction. Now, again, I'm a CPA. I'm not going to try to get into all the wickets of a tax return. I'm just going to talk about the bigger issues today. If you have a specific question, ask it. I can get a few of those, but I won't have time to answer them all on camera, but we can get you an answer if you have a specific question. 2018, then we saw married filing joint standard deduction jump to that huge number of 24,000. In 2019, we're then seeing an increase of it up to 24,400. So we're seeing that increase happen already, which means if your adjusted gross income is, say, $100,000, then we get to immediately subtract 24,400. Is that good or bad? Well, if you are making, let's say, charitable contributions and you're paying interest on a home mortgage, those two things and whatever else you have on deductions have to be worth more than that 24,000 figure, or else you will not get to itemize those deductions. As you're doing your 2018 return, you're about to feel the effects of not getting that itemization benefit on the return. In exchange, I'll show you in just a moment, the rates are a little lower, but that standard deduction is higher, which does mean, and they even revamped the 1040. I'm sure not many people have looked at that. I'm sorry, I enjoy looking at that kind of stuff. But the 1040 has been greatly simplified on the front page, and many, many Americans will be able to have a simpler return. One of the main factors is itemization now of your deductions will not happen for most Americans because of this high standard deduction. So that didn't make sense. Let me know and I'll clear that up for you, but that's the number that we get to deduct from our total income as we go. So we also have some tax bracket changes. So again, a pretty significant one happened in 2018. So I've put that on the screen for you here. And just as a refresher how this works, the graph is showing the numbers for married filing joint. Down below on the screen, you see the single rates being spelled out here. So on the first 19,000 of income, we're at 10%. Everything from 19,000 up to the 77,000, you're at 12%. And then when you go from 77 above, everything beyond that limit is at 22%. So you're stepping through the tax brackets as you go. That's 2018 numbers, and that 12% bracket used to be 15%. So there was a 3% savings on that, and some other adjustments that were made in the tax code from the Tax Reform Act that was passed for 2018. So we're about to see the implementation of this on your tax return. Now, watch carefully. Let's pick a number to look at. How about this 77,400, which is the big number that goes from the 12 to the 22%? And I'm going to click here. And we just switched into 2019, which shows 78,950. So again, not a huge jump, but you see those brackets edge up a little bit. So you get a few more dollars this year than last that you get to pay the 12 cent on the dollar rate before you jump into the 22 cent on the dollar. But these rates are quite low. When we look at history, we see a fairly significant low point in our tax bracket system relative to the last, whatever you want to call, 70 years of history. All that to say, what do we do with that? Well, I'll pause for just a moment and give you a little application. If you think taxes are fairly low right now relative to where they might be in the future, which again, I won't take that poll or that survey because I have done it many times in the classroom setting, and almost all the time, I would say 99.5% of the time, people believe that taxes are going to have to go up later, and the page you're looking at now will be worse in the future. Why? Because, we got to pay for $20 trillion worth of debt somehow. And again, when we look historical, we're at low numbers. So will taxes go up? Just a point of application. If you think these numbers are good and low relative to the future of the rest of your life, should you consider more Roth and less tax deferral, right? Traditional TSP says, don't tax me now at these rates, wait and tax me later in the future at whatever those rates are then. Whereas the Roth says, I'll pay the rate now, the known number, in exchange for not getting taxed into the future at whatever that rate is that I don't know. That's the trade-off that you're making. Last point on this, and I will move forward. In actual planning, which is better? Is it better to do traditional or to Roth? And there are three scenarios that play out with taxes. Here they are. Scenario number one, taxes go down. If taxes go down, you wish you had not paid now and you had paid later. Scenario number two, taxes go up. If taxes go up, you wish you had paid tax now, done the Roth bit, and not had to pay that higher tax in the future. And scenario number three, taxes stay the same. If taxes stay the same, it doesn't matter if you do traditional or Roth until you turn 70 and a half. What happens at 70 and a half? We have required minimum distributions. The government will demand that you take, in the first year it's 3.65%, a portion of your retirement fund, take possession of it, add it to your income, pay tax on it. If you don't need it, you can save it again, but not in tax-favored status. You lose that tax-favored status forever with your required minimum distributions coming out of a taxable account. So in that scenario, if taxes stay the same as you go through your 70s, you steadily lose being traditional versus being Roth with your money. A bit more than maybe some of you wanted, but a good concept, a good reason why you might consider Roth. I think looking at the tax bracket page helps us see that in good clarity.